Hey, good morning, everybody. It's Eric Lay with Guaranteed Rate coming to you live with Charlotte Jean, Realtor at Birch and Cedar Realty. Charlotte, good morning. How are you doing today?
I'm great. How are you?
Good, thanks. Hey, everybody, this is our monthly or twice per month. Kind of depends on our schedules and how busy we've been. And trust us, the market has been a little crazy right now, but this is our Let's Get Real About Real Estate segment where Charlotte and I are both going to come to you with our perspective, her from the real estate as a realtor side and my as the mortgage lender side, with what we're seeing on something that's new or different or maybe even crazy in the real estate market. So we're going to come to you this time and talk to you about what we're seeing for housing and interest rates in 2021. So without further ado, we're going to go ahead and get started on this. And Charlotte, if you will just be my auditor of this, I want to make sure that I get this in okay. So let me get the screen share going here. Give me just a second. And Charlotte, would you just give me a thumbs up or a yep, I can see that screen okay?
Yep, we're good.
Okay, perfect. Well, again, we're just going to give you what we see coming down the pike at us for housing and interest rates in 2021. And we both want to disclaim right up front, and I'll speak for Charlotte on this. We don't have crystal balls, everybody. We have no idea what the market's going to bring. We just know what we think is going to happen based on history, based on what we're seeing from some economic fundamentals. And we're here to share all of that with you. So please don't take this as chiseled in stone. Charlotte and Eric know what's going to happen. Nobody really does, but we've got some pretty good educated guesses that we're here to share with you on this. So with that, let's go ahead and get started. The first thing I want to talk to you about is Janet Yellen. So that's Janet there on the screen. If you don't follow the Federal Reserve and the Fed speak, which I do because I'm a mortgage lender, and that's a lot of what I follow just to try to help my customers understand rates and timing on things, she is a former head of the Federal Reserve. She is now President Biden's Secretary of the Treasury. So Janet Yellen, if we want to go back in time a little bit, I'm just going to describe her as what we call a dove. And a dove in Fed speak is somebody who is very, very stimulus, pro-stimulus. Janet Yellen likes to spend money. We'll just say it like that. So combine Janet Yellen being President Biden's Treasury Secretary with Jerome Powell, who is the current Federal Reserve Chairman, we have the perfect recipe right now for a lot of accommodation into the housing market and into the Treasury market, which is used to fund government spending. And you probably hear about this in the news and mass media right now. There's this $1.9 trillion bill that's getting thrown around in the media. And just for point of reference, we're coming to you in February of 2021 here. So about a month or so after President Biden took office. There is going to be a lot of spending. And I want you to understand what large and heightened government spending means to mortgage rates. So here's another chart I want to show you here. And this is comparing mortgage rates, which is the blue line, to the federal funds rate, which is the red line. Okay. The Federal Reserve, which is headed by Jerome Powell right now, has set interest rates basically at 0%. Now, that's federal fund rates. That's not mortgage rates because you can see the difference there. But those two tend to move very similar patterns, okay? Not all the time. But you can see if you track back, and this is since 1981, I think, the trend for mortgage rates has been lower, as has the trend for the federal funds rate. Now, you notice that they don't always move together. There was a period right there you can see back in 2009 where there was a divergence, right? A little spike there in rates, about a % spike, and another one there where rates definitely separated. But you can see that the trend is pretty much the same. The thing that I want you to take away from this is that in periods of heightened government spending, interest rates typically move lower. So take a look at this chart. You can almost see that it is an exact correlation, which we call a negative correlation. So the blue line right here are interest rates. The pink line is the amount of government debt. Now, clearly, we are in a period of heightened government spending. I think the total government debt right now, I think that we're at a deficit of around $27 trillion. it's crazy. And we don't even want to debate whether that's a good thing or not, because I think we can all say that's a lot of money that's out there. But the point that I want you to take away is that there is a negative correlation between rates and debt. So as the amount of government debt increases, the percentage on interest rates for Treasury debt or Treasury financing decreases. And it happens almost perfectly with that negative correlation. You can see all the way back to the early 1950s. Now, you can look at other countries around the globe and see the same thing here. In the top left, there is France. In the top right is Japan. The bottom left, Italy, and then the United Kingdom in the bottom right. You can see almost the exact negative correlation, meaning in periods of heightened spending, there are lower interest rates. And I want to talk to you just a little bit about why that's the case. Because if you think about what happens when there is debt that's used to purchase things today, and Charlotte, you'll understand this too, because I know we talk to our clients about this. Let's use an example of buying a car as an example. Now, if I want to buy that brand new Tesla, let's say today, and it's $80,000, I've got probably two choices. I can go into my savings account and get the $80,000 that I've been saving up for that Tesla and just go out and pay cash. Probably not very many people do that, right? Partially because interest rates are so low with banks and credit unions for automobile loans. So I will go out and I will finance that $80,000 Tesla. Maybe it's at a rate of 3% or 4% or 5% or whatever, right? And I take those payments then and I spread those out over 5 years, 6 years, 7 years, whatever. Well, think about the economic activity that happens today when I take out that car loan. The dealership that sold me the Tesla, they're happy. They made another sale, right? The car salesman who collected a commission for selling me that Tesla, he's happy. Heck, I'm even happy because I've got that bright, new, shiny Tesla to drive around. But that's today. Think about what happens the next 5 years or 6 years or 7 years when I've got a $682 car loan payment, right? That is going to change my spending for the next 5 years or 6 years or 7 years. So I want you to think about that the same way as the government spending is. Now, clearly the government can spend into the deficit, and not to get political, but they're doing a pretty damn good job about spending deficit, right? But you can see what the dynamic is that there creates, right? If there is spending in the future that's brought into the present, there is going to be a drag on spending in the future because we have a bill to pay. So it's the same kind of thing with that government debt. And when we have heightened levels of government spending, rates have to come down because otherwise there isn't any way to spend money. And so, Charlotte, we've been seeing a lot of that with mortgage rates right now, as you know, and I know that that's created a real positive affordability for housing right now. And I don't know if you want to take just a few minutes and talk about what you're seeing with regard to housing and what your clients are saying with regard to interest rates, because clearly mortgage rates are really low right now.
Yeah, I mean, I think that a lot of people don't really understand that there is that correlation where even though the appreciation of houses has gone up because of the interest rate being so low, it's offsetting that appreciation. And so the actual affordability of homes are more affordable now than they have been in the past, and could potentially be in the future if if prices did come down, but interest rates went up. Right now, you're paying less than you would be or have been. So.
Right. And I guess I'll end before we go to the next part of this on just understanding and thinking about what this all means for interest rates in the future. We do expect, and by we, I mean me, I don't mean my company, I don't mean anybody else, because this is my opinion and my opinion alone. I think that we are in for a period where we are going to see a blip higher in interest rates if this big spending bill that the Congress is considering passes. But after that's said and done, because of the graph that showed the correlation between heightened government spending and where rates go, it's more than likely going to settle down. So short term to maybe intermediate term, I would not be surprised if interest rates moved a little higher, but then we've got the table set for low rates for quite a while because Janet Yellen, Jerome Powell, two very powerful people, are very dovish. And we use that term because they are very accommodating and wanting to spend money to support housing and mortgages. So I don't expect anything long-term with rates to be higher. And that, who knows how long, right? But the table is set for lower rates for longer, maybe with a short-term blip up, and we'll see what happens with that spending plan. So, Okay, let's go back into the presentation then. And Charlotte, again, just a quick video check there. Can you see that chart again?
Yep.
Okay, let's move on. Here's the biggest disconnect that Charlotte and I see, and we talk about this all the time. People think that we are in a housing bubble right now, more so because prices have gone up pretty quickly in a short amount of time. Charlotte and I get that. But they're also thinking that this is a bubble because this feels so much like 2008 and 2009 when prices just fell out the bottom in the housing market. Well, here's a lot of evidence as to why we are not inside of a housing bubble. So take a look at this chart. Now, this is showing you demographic by population. So right now, the millennial generation, roughly from 1981 to 1997 in birth year, there are a lot of them. That's the easiest way to describe it, because if you look back at the baby boomers, that was the largest demographic of population ever. But look what's right behind it. It's the millennials. Now, we're seeing the median age for first-time home buyers in this particular generation to be 32 to 33 years old. So I want you to see and focus on where 33-year-olds are right now in this generation, okay? There's about 3.7 million of those people, but I want you to see how many 32-year-olds there are, and then how many 31-year-olds there are, and then how many 30-year-olds there are. Even 29, 28, and 27 and 26-year-olds, there are more of all of those age groups than there are the 33-year-olds. So in short, what does that mean? There are a lot of first-time home buyers that are coming at Charlotte and I to try to buy homes because they're getting to that sweet spot of that 32 to 33 years old, where most people are buying their first home. So if you have that kind of demand coming down the funnel, and guys, I'm telling you, if you're renting an apartment right now and you're 27 years old, it's not going to last forever. Tell me who you know in your personal life that rents an apartment and plans to stay there for the next 20 years. Very, very few people, if any, would do that, right? So household formations, most people do have an apartment at some point in their life, but even look at your own experience and go back in time. It's probably not a long-term thing. You are going to move out of an apartment and into a house. So what does that mean for a house? It means you're either going to rent a house or buy a house. Now, part of the thing that's driving demand right now also is low inventory. Charlotte speaks to that on these previous episodes really well, but in short, and we don't want to belabor the point, we have a lack of inventory right now that was partially impacted by the COVID pandemic. Because when the shutdowns first started happening in March and April of 2020, everybody was told stop working, go home, shelter in place, quarantine, you know, all of that stuff. Now, certainly in some parts of the country, more than others, of course, we moved out of that and are starting to open up more. But there was definitely a disruption in housing starts that's evidenced by this chart. Even that small blip right there in March and April and May of 2020 caused an already low and dire inventory situation to get worse. And it's just not like builders can snap their fingers and pick up that inventory again. It takes time to build houses, right? So we don't have enough new construction for sale. Further compounding this is the fact that we have really low vacancies, as is evidenced by this chart here. You can see that there is a lot of rental out there and not very much vacancy. I think that we're at is this chart was back sometime in December, I believe. We're at about an 8.5, 8.6% vacancy nationwide with regard to housing. That's not very much historically, because you can see if you go back to 2010 at the highest point ever, we're not even close to the 11%. We are pretty low compared to that. So when you have a shortage of housing and you have a shortage of housing rentals and apartment rentals, all it does is set the table for higher rates of rent as well. So people are going to get tired of paying high housing rents, right? If your apartment manager or your landlord in the house you're renting says, hey, by the way, Charlotte, I'm going to raise your rent 10%. Can't tell me that's not going to make you think twice about wanting to buy a home, because you're going to get sick and tired of rising rent rates at some point. So the last slide I will show you is just the inventory levels, because again, when Charlotte and I hear from a lot of our buyers about how they're concerned about there being a housing bubble, I want you to really hyper focus on 2006, 7, and 8. That's where my mouse is on there. That was a housing bubble, and you can see how much inventory there was at that point, right? Well, look at
Yeah.
how much inventory there is right now comparatively. This tight inventory, which is even tighter today than even some of the lowest points we've seen in the last 8 to 9 years, is only going to push housing prices higher. Because if you just want to simplify this to a simple supply demand dynamic, it is just going to do nothing except push housing prices higher because of that supply and demand. I'm going to leave the screen up on here for just a second so you have all of my contact information you want to get out in touch with me. At the end of the presentation, Charlotte's going to post her contact information in the Facebook Live comments as well. But we want to just make sure that you understand, we just don't see any evidence that we're in a housing bubble, because if you look at the last true housing bubble, which again, we can look back in time and we can see that that was clearly a bubble, because when the bottom fell out and prices dropped like that, that was a bad thing. But there is no similarity in these metrics from what we just showed you between what we're seeing in today's housing market now and what we saw then. So housing bubble, I mean, nobody knows until we're through this, whatever this is, right? But I think when we come out on a more balanced housing market, we're going to look back at this and not see any evidence of a bubble because of all of the things we just shared with you. Charlotte, I've been talking a long time. I need to breathe for a minute there. So let's turn it over to you for just thoughts and what you think about this as well.
Well, I mean, I hear, like we've mentioned before, we hear a lot about housing bubble, housing bubble, housing bubble. That is constantly on replay in the news. Of course, it's kind of a clickbait because they want to scare you so they can get advertising dollars, all that stuff. But it's true. There's so many people that are buyers in this market looking for homes that there's just no inventory. I mean, less than 2 weeks, less than a week, depending on areas. It's pretty crazy. And it's not just the fact that new homes haven't been built. It's because of the rates being so good, sellers are refining instead of actually selling. So there's just a lot of reasons why people are staying in their homes. There's not enough inventory. And so it would be really hard for there to be a bubble just because of the high demand, the low supply, interest rates are great, all of everything that you just said. So I concur wholeheartedly. And I think it's really important for people to understand that while housing prices have increased dramatically, because interest rates are low, there is an offset into that affordability. So you may think that you can't afford it, but rents, there was just something I saw that popped up in my email just before our call that said that there was a study done and Boise's rents have gone increased higher than other places, most places in the country. And I haven't read the article, so I don't know all of the details. But that, of course, it's a headline. But it's something to think about. I know from experience hearing from my buyers, people are raising rents, and it's more affordable to buy than it is to continue to rent at this point because rents continue to increase. Yeah. And rentals are actually pretty hard to find also. So just all around, if you have questions about affordability, please reach out to us because you're much better off getting into a home and building up that equity than paying your landlord's mortgage. So
Preach, my friend. Yes. And I'll just add a couple of more things to what Charlotte just said to build on that, because the idea of affordability sometimes gets lost on people when they see the price points. And you have to make sure that you think about the big picture of what she means when she says affordability. If you buy a house today, and I'm just going to make a number up, let's say that you buy a house today for $400,000, and we're seeing annual appreciation rates greater than the historical averages, which historical averages, if you go all the way back to when that's tracked, that's around 3 and 3.5%. That's normal historical over 50, 60 years. We're seeing almost double-digit increases in price of homes and those values moving up. So if you take it from that standpoint, buying a home today with all of the supply demand imbalance we just showed you, with the lack of inventory, the huge amount of millennial buyers that are coming into their prime home buying ages, and then combine that with the low interest rates, buying a house now, even at these seemingly high prices, is just going to build equity over time because homes always go up over the long term. Now, you can certainly look back at times where housing values has dropped, AKA housing crash 2008 that we were referencing in this. But because we don't see the same formula right now, and because we don't say the same things happening right now, that home's value should continue to appreciate. So by not buying now and continuing to rent because you get nervous because prices are so high, you're also giving away that future equity and appreciation that you would otherwise get. So it's a bigger picture than just price points and low rates, because you're also taking out of the picture that equity and appreciation that you'll get by buying now into a market that is growing. So it's a hard thing to think about. It's a big picture concept that's sometimes hard for everyone to grasp, but that's why Charlotte and I are here to help you make sense of these situations and try to make sense of your specific situation and what is the best thing for you to do right now. So like she said, we're always here to help. We're absolutely able to answer questions that you have about your own specific situation. She on price points and market, me on affordability and whether or not you can buy that. So please reach out to us. We'll leave all of our contact information in the comments on the Facebook Live feed. And we're definitely here to help and support you and anyone that you know that needs our help.
Absolutely.
Okay, well, Charlotte, great segment today. Thanks so much for making this a part of your day with me. I love doing this with you. And again, feel free to reach out to us if any of you have questions we can answer for you. We're here to help.
Excellent.
Thanks, Charlotte. Take care. Thanks. We'll talk to you next time, okay?
All right, bye.
Okay, bye, everyone.